We look at the flows this year. We have 16 trading days so far this year. And boy, are people buying ETFs left and right. We've got $52.7 billion in year-to-date flows. That's a $3.3 billion a day pace. That's 50% more intense than the flows last year. So what is the difference this year? The X factor is SPY. SPY alone has put in $14 billion in flows. Now, SPY normally has bad Januaries, so that's despite that. So what I interpret this as is traders are very excited about the market right now, namely equities. IVV is number 2, but IVV is more allocators, so that's the buy and hold crowd. So what you have is traders and buy and hold on the same page, both loving equities. What's seeing outflows, if anything, so far this year? We look and we see not much, but what sticks out to me is a couple junk bond ETFs, HYG, JNK, and then BKLN is a little further down. $2 billion out of junk bond ETFs. Could be rising rates. Normally you see those on the other side when there's a risk-on trade going on. But right now we're seeing flows out of junk bond ETFs, which is interesting, but this to me is the story so far this year in the flows.
All right, we'll get more of a read on that. I want to welcome Howard Marks, co-founder and co-chairman of Oaktree Capital Management, the world's largest distressed debt manager. And when Howard writes memos to his clients, as he did this week, investors sit up and listen. Howard, what is your takeaway when we get data showing that money is flowing into SPY, big cap U.S. stocks, and out of high yield credit?
Well, you can look at it constructively or not. The constructive interpretation is that people have made a decision that interest rates are going to be rising, and that's bad for bond investments, and so they should get out. And that you can't argue with that conclusion. Mm-hmm. The less constructive interpretation would be that stocks did so much better than bonds last year that now everybody says, oh, I want stocks. Now, what they really want is stocks a year ago, or maybe stocks 8 years ago. But of course, you can't buy that. But you know, people misinterpret, and they think that what it did last year is indicative of what it's going to do next year.
So it's momentum building on itself. At this stage of the market and economic cycle, what are you more concerned about? Equity ETFs that you say keep driving prices higher, which attracts more bids, or high yield ETFs that promise liquidity, even though the underlying securities can be pretty illiquid?
Well, good question. Which do I worry about more? The easy answer is that I worry about both. I'd have to struggle to quantify it. But you're right. You know, I've written about high yield bond ETFs, and you know, high yield bonds are inherently illiquid, and people buy ETFs instead of bonds themselves because they think that the ETF is liquid. But how can an investment vehicle be more liquid than the underlying assets? So that's a big question. And then, of course, as to stocks, yes, you have to worry about piling into stocks after they've had a big run. Mm-hmm. You know, I put out this memo this week that you mentioned, and the PE ratio on the S&P 500 is about the third highest in history. And, you know, you have to think about that. So the answer is we're in a low return world, and there's no easy place to invest.
One of the most interesting things I think you've written about is this buying of assets on autopilot, right? Through passive funds like SPY. It's definitely true. There's been just about $1 trillion buying that money. Now, I'm curious what you make of smart beta, which is it's a rules-based index, but it takes active fundamentals that active managers like and puts it into the recipe of the index and then buys them based on fundamentals. Curious what your take is on smart beta.
Charlie Munger once said to me, Warren Buffett's partner, none of this is meant to be easy. Anybody who thinks it's easy is stupid. Can you do better by going from a passive vehicle to an active vehicle, which is what a smart beta is? It's I guess we'd call it a semi-active vehicle. And the answer is, if the decisions that are made are good ones, it'll be better. And if the decisions that are made are bad ones, it'll be worse. So there's the great thing about the investment business, there's nothing you can do which just by doing it is going to make you richer. You have to do it right. And you know, if you say I want to have a smart beta fund, and I want to emphasize small caps and technology and low quality, that's an active bet on those factors. If you made a good decision, you'll make more money than a passive fund, and if you made a bad decision, you'll make less.
Now, whether it's passive or semi-active, whatever form of the ETF, I wanted to get your take on HYG and the kind of dislocations it's had in the past. We spoke with Matt Tucker, the head of iShares Fixed Income, about whether HYG would ever trade at an 8% premium or discount to its net asset value like it did in 2008.
Yeah.
He said it's unlikely, and then he followed up with this explanation. Let's listen.
If those premiums or discounts, what it's telling you a lot of times is the ETF is telling you where the market is. So a lot of times if the ETF's at a premium, that's because the underlying bonds haven't yet been marked up. Their prices are not yet reflecting new market information, which the ETF reflects real time.
So Matt is essentially saying that ETFs can be an efficient price discovery vehicle in illiquid securities. Do you think he's right? Is he wrong?
I guess in theory he's right. You know, I think what he's saying is that that ETFs trade more actively, and in a shorter time frame, so they price more currently. And what he was saying is that you can have an ETF which is underlaid by, let's say, 100 bonds. Those bonds haven't gone up, but the ETF has, on the assumption that the bonds are going to. It may work, and again, it's an active decision, and do you like it? But you know, most of the time they tell me ETFs should trade in line with NAV, and the great word in that sentence is should.
Right.
And I've seen a lot of times in my 49 years in this business when should and will were not the same thing. Sometimes the things that should happen, and sometimes the things that should happen don't happen.
Right, right.
Just on that note, we heard that you're going to work with Eaton Vance to file a Next Shares, which is an exchange-traded managed fund, which is a way for active managers to utilize the ETF structure but not show their holdings every day. What was behind your decision to get involved with that?
Well, an ETF is a vehicle for participating in a certain set of securities. It could be a passive index. It could be a smart beta, where you're trying to augment the return on the passive index by making some active decisions on style. Or it could be active management, delivered through an ETF, delivered through a vehicle which is traded on a market. As long as people buy ETFs for the right reasons and with the right expectations, I think they're fine. And I think it's a way to deliver an investment product to the retail market. We would not, first of all, we're not involved at all in passive investing or even in smart beta, semi-passive, let's call it. And you know, we're active managers. We're trying to, we manage a relatively small amount of money compared to the ETF giants, and we try to find little opportunities to add value. So the ETMF permits us to do both, permits us to deliver the product through the ETF market, but also to have active management. Now, we wouldn't want, you know, ETFs have to disclose their holdings every day. We wouldn't want to do that. First of all, it's laborious, and secondly, people can front run you.
Right, right.
And so the ETMF doesn't have that requirement. We think that's a good solution.